Are these 5 rookie ETF mistakes hiding in your account right now? If you're new to investing in ETFs or exchange-traded funds, you might think it's as simple as buying a few shares and letting the market do the rest. But hold on, even this seemingly straightforward tool can trip you up if you're not careful. Today on the Capital Breakdown, we're breaking down the 5 most common mistakes new ETF investors make, why they happen, and how understanding them can put you on a steadier path. By the end, you'll see ETFs in a whole new light. Less mystery, more confidence. Let's dive in. Many people jump into ETFs thinking they're a one-stop shop for easy investing. After all, ETFs bundle lots of stocks or bonds into a single purchase, so it feels like a shortcut to instant diversification. But here's the catch. That simplicity can sometimes mask bigger issues. It's like buying a mystery basket of groceries without checking what's inside. You might end up with items you don't want or need. People often confuse ETFs with safe bets, or they don't realize how their personal goals and timeline affect which ETFs actually fit their plan. We see this confusion all the time, and it can lead to frustration, unexpected losses, or missed opportunities. So what exactly is an ETF? Think of it as a big basket filled with different investments, stocks, bonds, or sometimes other assets that you can buy or sell on the stock market just like a single share of a company. Picture a highway with many cars. The ETF is like a vehicle carrying a whole group of those cars together, so you don't have to buy each car individually. This bundling gives you instant diversification, which is a fancy way of saying your money is spread out, so it's not all riding on one horse. ETFs come in many flavors. Some track a broad market index, like the S&P 500, meaning they hold a slice of the biggest companies. Others focus on specific sectors, regions, or investment styles. Knowing this variety is the first step to avoiding rookie mistakes. To understand ETFs better, imagine you're at a buffet. Instead of ordering one dish, you get a plate with a bit of everything: veggies, proteins, grains. That's like an ETF holding a mix of assets. Index ETFs try to mirror the entire buffet, taking a little from each dish to match a market index. Actively managed ETFs, on the other hand, are like having a chef pick and choose what goes on your plate, aiming to beat the buffet's average. Both have their merits, but knowing which type you're dealing with helps set realistic expectations. And just like buffet prices vary, ETFs charge fees called expense ratios, which cover management and operational costs, a key detail often overlooked by beginners. Behind the scenes, ETFs work through a collaboration of fund providers, authorized participants, brokers, and regulators. Fund providers create and manage the ETF, deciding what goes in the basket, handling administrative tasks, and setting the rules. Authorized participants are special players who help keep the ETF's price close to its actual value by exchanging the underlying assets for ETF shares and vice versa. Brokers are your gateway to buy or sell ETF shares on the stock exchange, while regulators oversee the whole system to keep it fair and transparent. Money flows in when investors buy ETF shares, which the fund then uses to purchase underlying assets. When selling happens, the process reverses. But remember, some ETFs trade less frequently or have wider bid-ask spreads, meaning the price difference between buyers and sellers can cost you, especially with thinly traded or niche ETFs. Imagine 2 investors, Alex and Jamie. Alex decides to regularly invest a fixed amount each month into a broad market ETF that tracks a wide index. This steady approach, sometimes called dollar cost averaging, smooths out market ups and downs over time, making investing less stressful and more consistent. Jamie, on the other hand, tries to time the market by buying and selling a single speculative stock based on rumors or news. Jamie's roller coaster ride of emotions, excitement during gains and panic during drops, illustrates the risks of concentration and speculation. While ETFs can help reduce that roller coaster by spreading risk, jumping into highly specialized or leveraged ETFs without understanding them can bring similar thrills and spills. The key takeaway? Know what you're buying and why. Now let's talk about where new investors often stumble. First, chasing the hottest sector or theme ETF without considering how it fits into a bigger plan can lead to a lopsided portfolio. It's like eating only dessert every day, tempting but not balanced. Second, ignoring fees or trading costs can quietly eat into returns over time. Even a small expense ratio difference makes a big impact when compounded. Third, buying ETFs with too little research on what's inside means you might own a basket of volatile or risky assets without realizing it. Fourth, using ETFs as quick flips or short-term trades can backfire, especially if you don't understand market swings or tax implications. Lastly, neglecting patience and long-term perspective often leads to emotional decisions that hurt performance. ETFs are powerful tools, but only when used thoughtfully. Thinking bigger picture, how do ETFs fit into your overall financial life? They're not magic beans, but rather building blocks for your financial goals. Before investing, it's crucial to have a budget, an emergency fund, and clarity on your time horizon. Whether you're saving for retirement, buying a home, or just growing wealth, ETFs can provide core exposure to markets, but your allocation should reflect your risk tolerance and timeline. Remember, diversification is about more than just owning multiple ETFs. It's about balancing stocks, bonds, and other assets to weather different market conditions. And always keep your eyes on the prize. Steady progress over time, not quick wins. Let's recap the big ideas from today's episode of the Capital Breakdown. First, ETFs are baskets of investments that offer convenience and diversification, but they're not one-size-fits-all. Second, common beginner mistakes include chasing trends, neglecting fees, misunderstanding what's inside the ETF, and treating ETFs like quick trades rather than long-term tools. Third, successful ETF investing requires patience, a clear plan, and ongoing education. Remember, this video is purely educational. It's important to do your own research and consider talking to a qualified financial professional who can help tailor strategies to your unique situation. Thanks for tuning in, and here's to building your financial confidence, one smart step at a time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice. Risks, traps, and common mistakes. Continued. Another pitfall is using leveraged or inverse ETFs without fully grasping their complexity and risks. These products aim to magnify daily returns and can quickly erode capital if held long-term. For most beginners, sticking with straightforward low-cost ETFs aligned with your goals is wiser. And always keep in mind that investing is a marathon, not a sprint. Short-term volatility is normal, but staying invested through ups and downs typically leads to better outcomes. How to think about this tool. Putting ETFs into your broader financial picture is crucial. Before investing, ensure you have a solid emergency fund and a budget that supports your goals. ETFs can be great building blocks for retirement accounts, college savings, or other long-term plans, but they're just one part of your financial toolkit. Think of ETFs as reliable roads to get you where you want to go, but you still need a map, your personal goals, timeline, and risk comfort to navigate successfully. Never forget to review and adjust your plan as life changes. Good investing isn't about chasing the latest fad. It's about steady progress, learning, and making decisions that fit your unique journey. How to think about this tool. Continued. Also consider diversification beyond just ETFs, balancing stocks with bonds, cash, or other assets to smooth out risks. And keep educating yourself. The more you understand the markets and financial products, the more empowered you'll feel managing your money. The Capital Breakdown is here to help unravel these concepts and keep you moving forward with confidence. Recap and educational disclaimer. All right, let's wrap up. Today we broke down 5 rookie ETF mistakes: chasing trends, ignoring fees, poor diversification, market timing, and misaligning with your risk tolerance. We explored how ETFs work like baskets of assets you can trade easily, but also why knowing what's inside and understanding fees matter. Most importantly, investing with ETFs requires patience, a clear plan, and realistic expectations. No shortcuts or guarantees. Remember, this is educational content designed to help you think smarter about your money. Always do your own research, and consider talking to a qualified financial professional before making investment decisions. Thanks for sticking with the Capital Breakdown, where we make money sense one concept at a time. Keep learning, keep growing, and see you next time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.